Welcome to the enlightening journey on understanding the impact of inflation on your investments. In this comprehensive guide, we'll delve into the implications of inflation on various asset classes including stocks, bonds, and real estate. As we traverse this intricate landscape, we'll provide insights on how you can safeguard your investments against the corrosive effects of inflation. Let's start with a granular look at inflation. It's essentially the rate at which the general level of prices for goods and services is rising. While this might sound innocuous, unchecked inflation has far-reaching consequences on your investments. Inflation erodes the purchasing power of money. In other words, a dollar today will be worth less tomorrow. First and foremost, inflation has direct implications for your cash. Leaving large stashes of cash idle might seem prudent, but the reality is that you're actually losing money over time due to inflation. Next, we move into the impact of inflation on bonds. Bonds, traditionally seen as a safe haven, promise a fixed interest payment over time. Yet, this stability can curtail your actual returns when inflation persists. For instance, if your bond yields 3% annual interest, and inflation is running at 2%, you're only earning a meager 1% real return. On the flip side of the coin, inflation has a more complex relationship with stocks. While inflation can lead to higher interest rates, which has implications for stock prices, it's not all doom and gloom. History indicates that stocks have effectively boosted investor returns during moderate inflation periods. The main distinguishing factor here is the company's ability to adapt to inflation. Firms with strong pricing power, which allows them to pass on rising costs to consumers, are typically winners in an inflationary landscape. On the other hand, companies with inflexible price structures can find themselves struggling. The final asset class in our exploration is real estate. Historically, real estate has been a go-to option for investors looking to guard against inflation. The reason for this is simple: property values and rental income generally rise in tandem with inflation. But this hasn't always been the case. Collapsed real estate bubbles and the housing crash of 2008 are stark reminders that real estate is not immune to economic turmoil. Inflation-induced market uncertainty can also impact commercial real estate, with businesses restructuring their leases to offset higher rental costs. So, how do you safeguard your portfolio against inflation? There's no one-size-fits-all approach, as strategies should be tailored to your investment goals, risk tolerance, and financial situation. However, there are a few common techniques you can employ to hedge against inflationary pressures. One strategy is diversification. By investing across different asset classes, industries, and geographic regions, you can potentially minimize the impact of inflation on any single part of your portfolio. For instance, you may want to consider Treasury inflation-protected securities, TIPS, which provide a guaranteed rate of return that's explicitly tied to inflation. Second, you can consider investing in commodities. As tangible assets with intrinsic value, the prices of commodities typically rise with inflation. This includes precious metals like gold and silver, as well as consumption-based commodities such as agricultural products and energy resources. Leveraging the strength of equities is another tool in your investor's toolbox. As an ownership interest in a company, stocks offer investors the ability to participate in a firm's earnings and potential price appreciation. Again, focus on companies with durable competitive advantages and stable, or ideally growing, dividend payments. Additionally, utilizing your real estate investments to construct a resilient portfolio is prudent. Consider the type of property, location, and tenants. Residential properties are typically in more stable demand than commercial properties, and certain locations can be inherently more inflation resilient due to demographic and economic factors. Overall, plenty of ammo exists in an investor's arsenal to combat inflation. By understanding how different asset classes are impacted by inflation and tailoring your investment strategy accordingly, you can fortify your wealth against the silent tax that is inflation. Lastly, let's explore the concept of purchasing power. Simply put, purchasing power is a representation of how much you can buy with your money. As inflation increases, the purchasing power of your money decreases. This means it's not enough to focus solely on earning higher returns, you also need to aim for consistent, inflation-beating returns. Investors also need to understand the interplay between nominal returns, real returns, and inflation. While nominal returns refer to your return before accounting for inflation, real returns are what remain after subtracting inflation. Hence, the goal is to generate real returns that surpass the prevailing inflation rate. To illustrate this concept, let's consider a hypothetical investment that promises a 5% annual return. Suppose that inflation is running at 2%. In this scenario, the real return on your investment is 3%, which is 5% 2%. Investing solely in low-yield, fixed-rate instruments exposes you to the risk of not achieving the real returns you need to preserve purchasing power. For this reason, maintaining a balanced portfolio is crucial. While bonds and cash can provide stability, Allocating a portion of your investments to stocks and real estate can potentially shield you from the erosive effects of inflation. Bear in mind, however, that with higher potential returns comes increased market risk and volatility. Ultimately, a sound investment strategy needs to navigate between risk and return while factoring in the eroding force of inflation on your purchasing power. With careful planning, a diversified portfolio, and astute investment choices, you can tailor your financial strategy to weather the storm of constant price increases. This practical and knowledgeable guide to inflation and its impact on investments serves as an essential reference point. As inflation continues to be a part of the economic environment, understanding its implications is key for devising a comprehensive investment strategy that safeguards and enhances your wealth over the long term. At the same time, throughout this journey, bear in mind that managing and preserving your wealth isn't just about beating inflation. Asset protection, minimizing tax liabilities, planning for retirement, and philanthropic endeavors are some of many other facets that should enrich your financial strategy. Think about long-term investment horizons. Economic cycles may bring periods of high inflation, followed by periods of low inflation or even deflation. For this reason, avoid making hasty or emotional decisions based on short-term fluctuations. While we've covered a lot of ground in our exploration of inflation's impact on investments, there are other intangibles to consider. These include political risks, socioeconomic factors, and unpredictable events that can ripple through global financial markets. Nonetheless, armed with the right knowledge and tools, you can chart a course that navigates the complexities of the financial world. Furthermore, personal circumstances can also shape your financial objectives. From saving for a child's education to planning for retirement, different goals bring different time frames and varying risk tolerances. Balancing these needs within the broader context of inflation and market conditions is a critical aspect of making informed investment choices. Lastly, always approach aligning your investments with inflation from a lens of risk management. This means taking a prudent approach, conducting thorough due diligence, and focusing on long-term investment objectives. By embracing these precepts, you can forge a resilient portfolio that stands the test of time and inflation. As we wrap up, let's consider our learnings in the context of a practical, actionable plan. Begin by assessing your investment portfolio in light of inflation. Reflect on its composition, your exposure to different asset classes, and the proportion of your investments susceptible to inflationary pressures. Next, evaluate the real returns that each asset class in your portfolio is generating after accounting for nominal returns and inflation. Identify gaps that need to be bridged to achieve higher real returns and preserve purchasing power. Then, make necessary adjustments in your investment strategy. This could involve increasing allocations to inflation-protected securities or commodities, reevaluating your stock selection to tilt towards companies with robust pricing power, or reallocating the geographical and asset class diversification within your real estate investments. Also, keep an eye on economic indicators and market data for signals on changing inflationary trends. This information can help you anticipate and proactively shield your investments from upcoming inflationary pressures and make course corrections in your investment strategy. Finally, remember that your investment journey is dynamic. Circumstances change, markets evolve, and new investment opportunities emerge. So, regularly review and adjust your investment strategy to align with your financial goals, risk tolerance, and market conditions. All things considered, the battle against inflation is a sustained, methodical process. There isn't a quick fix, but with a nuanced understanding of inflation and a broad arsenal of investment options, you're well equipped to emerge victorious in the journey of safeguarding and enhancing the value of your wealth. And, one last pro tip, don't forget to shield your earned income as well. Increase your earnings with job growth, keep abreast of salary adjustments within your industry, and constantly strive to add more skills or responsibilities to your job. This protection against inflation on both the income and expenditure sides is key to financial well-being. Together, we've unraveled this complex relationship between inflation and investments. From understanding the basics of inflation to navigating its impact on different asset classes and devising a robust investment strategy, your journey towards inflation-proofing your investments is indeed commendable. Fear not the challenges that inflation poses to your investments. Instead, equip yourself with the knowledge and wisdom to turn the tables on inflation and make it a catalyst for growing your wealth and reaching your financial goals. Here's to a prosperous and inflation-resistant financial journey ahead. Before we part ways, always remember that the path to financial success is paved with continuous learning, resilience, and adaptability. With these traits and the ability to integrate new insights into your investment strategy, you're well equipped to maneuver the ever-changing tides of the financial landscape and outmaneuver the silent thief that is inflation.